All right, guys, welcome to the part 2 of the introduction to what is Forex. Okay, from the previous video I made introducing you to Forex trading, I talked about what Forex trading is. I talked about currency pairs. I talked about major currency and minor currency. And I also talked about the exotic pairs. But right here in the part 2, we'll be diving more deeper and I'll be talking about things that are closely related to the market. Okay, before we continue, please don't forget to subscribe and like this video, as this will enable us to make more videos like this. And as well, you can leave in the comment section what topic you would like us to cover next in our next video. Okay, so today we'll be talking about, we're still in introduction to Forex. I'll be talking about what PEEP is. What is a PEEP in Forex? Okay, a PEEP is the unit of measurement in Forex used to express the change in between two currencies. Okay, every move in the Forex market is measured in PEEP. Remember from the part 1 of this video, I talked about currency pairs. I said you can't trade just a currency, you trade a currency against another. How we are able to measure the difference or the changes in the movement of price in the Forex market. We measure these changes using PEEP. Okay, so Euro USD, for example, Euro can move up or down 100 pips against the US dollar. Okay, so the word PEEP is actually a form of measurement. If you have something that looks very tall before you, if you want to measure it, you would be using length or height to do the measurement. In Forex, what we use to measure the movement of price in the Forex market is known as PEEP. I'll be giving close example that are related to all this as we proceed. So let's look at how the PEEP is calculated. Usually, price is quoted like this in the Forex market. You would always notice price is quoted as 1.15382 or whichever. Sometimes can start from 0 point. Okay, but the major thing I want you to know here is the PEEP starts from the fourth decimal place. Whenever you see price like this appear in the right side of your screen or the right side of your screen of your computer or your phone, what it is telling you is this is price of that particular currency pair, which I'll be showing us in a bit. So from the right side right here, what we have right here is 0.2 pip. That is a pipette, it's not up to a pip. Okay, so remember, a pip is a unit. 0.2 is not up to a unit. Okay, so it's called a pipette. And what we have here is 8. This is where the pip starts from. So the pip starts from the fourth decimal place, except for few currencies, which I'll talk about later. So in this case, we have 8 pips. In other words, 8 units. Okay, because it's a unit that makes a pip. So this is 8 pips. Right here we have 3 pips. Okay, 30 pips. If you put them together, it's 38 pips. Right here we have 5, which is 500 pips. If you put them together, it's 538 pips. Okay. Here we have 1,000. If you put it together, it is 1,538 pip. Okay. And right here we have 10,000. If you put it together, it's going to be 11,538 pips. So the pip starts from the fourth decimal place, except for JPY pairs. Let's quickly see that. You know what? I just mentioned what a pipette is. A pipette is 1/10 of a pip. I mean 1/10 is not up to a pip, so it's called a pipette. And usually, if you open your MT4, you would see the price being quoted like this, like what we have here, 0.9945, and then you see something like raised to power 6 or raised to power any number. That number that it is raised to is actually a pipette, but you can see the main price is 45. Okay, why the selling price is 45 in this case, why the buying price is 47 in this case. So the difference between the buying price and the selling price, like what I said in the first video, is 2 pip, because the difference between 45 and 7 is 2. So if you want to buy the pounds, what you need is you need If you want to buy the euro, what you need is you need 45 pounds to buy 1 euro in this case. If you want to buy the pounds, you need 47 euro to buy 1 pound. Okay, so I'm going to share. Let's look at the MT4 screen so we can draw an example from there. Okay. Okay, let's take a look at that quickly. Okay, sorry about that. So in this case, what we have right now, this currency is CAD CHF, CAD CHF. Okay, as you can see, the selling price is 0.7228. You can see the P37 is raised, and it's not stable because as long as the market is moving, it keeps changing. Okay, what this means right here, if you relate it to what I said earlier about buying price and selling price, talking about the spread, the difference between these two prices is known as the spread for this currency pair. Right now you have 27 to 30. The spread for this currency pair is 3. Okay, it's 28.31 now because the market keep moving. Okay, the spread for this currency pair is 3 pips. Okay, and you can see the spread right here where you see this red line and this black line coming closer to themselves. To know how bad the spread is, if they are so separated from each other like this, like what we have here on the lower time frame, this is a sign that the spread is actually wide. Okay, there are most currency pair, when you go to a larger time frame like 4 hours, you will notice is this wide. Okay, but in this case we seem to have a very tight spread because it's just 3 pips. Most spread are up to 7 pips, most spread are up to 10 pips, most spread are up to 15 pips. Okay, but what I'm discussing presently is not the spread. What I'm discussing presently is pip. So I said pip is the measurement in forex where we measure the movement of price between two currency. If you relate it to what I discussed earlier in the first video, in the part 1 of the introduction to forex, I told you that this graphical representation is representing the base currency basically. In this case, it's representing the CAD. At this point, you saw the market fall, made all this move downward. All this move the market made downward to this point. This is the CAD falling against the Swiss franc, which is the CHF. This is the CAD falling to the CHF. And then at this point where you see it rising, this is the CAD rising against the CHF, which means the CHF was falling. All right. At this point, where the CAD was rising, at this point where the Canadian dollar was falling, the CHF was rising, but we can't see the rise because this graphical representation is basically telling us what is happening to the base currency. So automatically we know that the quote currency, which is the CHF, is actually falling in value because it's actually rising in value because the base currency is falling in value. So what we do in forex is we want to know how great was the fall of the Canadian dollar. How we do that is by measuring the pips. What we do is we measure from this high where the fall started down to this point where it ended before it started rising. So how do we measure the pip? It's very simple. You can use your crosshair. It's a tool. You can click Ctrl F on your keyboard to bring it out, which is this, if you are using the MT4. Or perhaps you can just pick it here from the toolbar, which is what we have here. You can see crosshair. You click from the top and you drag all the way downward to where the fall stopped. You can see that we have 31/2880 slash the price level where the fall stopped. If you click from here, you notice we have the price level, which is here. I don't know if you can see that you can see at the end of the right side of my screen, you would observe that prices, you'll see prices are listed just right here. Okay, so you want to know how many pips Canadian dollar fell to the Swiss franc. All you need to do is click from the top and drag it all the way down to where the fall stopped. You will see that it fell The 31 you see right there is telling you how many candles, the amount of candles that read all the way down here. The slash, then the next one you're seeing after the slash is the peak. So the Canadian dollar fell to the CHF by 287 pips. I'm not mentioning the 9 because the 9 is a pipette. A pipette is insignificant. We don't pay attention to it because it is not up to a unit. Okay, so you can say that the Canadian dollar fell 287 pips to the Swiss franc. Okay, how about this rise? It started rising from here, and rose all the way up. Okay, rose all the way up to this level. How do you calculate this? How do you know the pip of the rise? How many pips it rose? You bring your crosshair, you take it from where the fall started, you drag it all the way up to where it rose to. You can see clearly that it rose 189 pips. All right, 189 pip. You can see that the Canadian dollar rose against the Swiss franc. All right, so that is how we calculate our pip. If you're using TradingView as because personally I use TradingView. I use TradingView for my analysis basically, and I take my trade on my MT4. So if you look at TradingView right here, how do you know the pip if we were to go for that card CHF? Card CHF. Okay. This is card CHF. Let's go to. You can see it's still the same market. How do you calculate the pip? I have a tool for calculating pip here. I'll take it from the top where I want to calculate to the low. And I can see that it moved over 287 pips. 288 pips, 287 pips. Okay. How about for the rise? I'll take it from where it started from, and I'll drag it all the way up to where the rise got to. And as you can see, it did 192 pips. Okay, so how do we calculate our pips? If it is in a selling market like this, you want to take the price level from the top, subtract it from the price below, you will know how many pips. If not, it's easier to just use the tools I've just shown you to know how many pips. All right, so it can be that simple and it can be that easy without having any form of stress. Okay, the next thing I'll be talking about is lot size. What is lot size in trading? Okay, lot size is actually a standardized quantity of buying and selling in the Forex market. Okay, and there are 3 types of lot size. We have the standard lot, we have the micro lot, we have the mini lot. Okay, these are the 3 lot sizes that are applicable in Forex. But in other form of market, we have the nano lot, like the volatility market. But in this case, that's not what we're talking about. So we'll just be concentrating on standard lot, micro lot, and mini lot. All right. Now, the standard lot has 100,000 units. The mini lot has 10,000 units. The micro lot has 1,000 units. Okay. These lot sizes, what lot sizes do is they determine, they actually determine the amount at which you're buying or you're selling in the Forex market. One of the perfect example I like using to explain this scenario is if 3 sets of people goes to the market, Mr. A, Mr. B, and Mr. C. If Mr. A goes to the market with 100,000, and Mr. B goes to the market with 10,000, and Mr. C goes to the market with 1,000, and they are, of course, they are going to buy. You would agree with me that the 3 of them will not buy at the same quantity. Of course, Mr. K is with 100,000. He will buy more than Mr. B, who is with 10,000. And Mr. B will buy more than Mr. C, who is with just 1,000. The same thing is applicable in the market. Some traders have the capacity to buy with 100 units. Some traders have the capacity to buy with 10,000 units. Some traders have the capacity to buy with 1,000 units. What determines the capacity of a trader to buy with any of these lot sizes is the amount of your trading account. Someone who has up to $100 in his trading account have no business using the standard lot size, as it is way too big for his account. Of course, a standard lot size cannot fit into a $100 account. Of course, that's why we have the lot sizes. You should know that since you have $100, the lot sizes that is advisable for your trading account is the micro lot size. Okay, how do you choose these lot sizes? You choose these lot sizes by paying attention to the volume. Since I have $100 trading account, what I would use is the micro lot size. The micro lot size ranges from 0.01 to 0.09. So if I'm risking 1% of my money, I'm going to be using 0.01 to trade my $100 account for each trade. Okay. Someone that has at least, let's say at least up to $1,000, and you want to trade, you want to reach just 1% of your capital, you are open to 10,000 units. You can use 0.1. Okay. So the mini, which is called the mini lot size, one mini lot size, it ranges from 0.1 to 0.99. Okay. So we have the one mini lot size, we have two mini lot size, we have three mini lot size, we have four mini lot size, we have, it just keep going and going on and on. Okay, someone with a large amount of money, let's say up to $10,000 in his account, has the capacity to trade a standard lot size. Okay, and the standard lot size varies. We have one standard lot, two standard lot, to infinity. You're not limited. You can even have 100 standard lots. Okay, the implication of this is this will determine your profits and loss level. Someone who is using 0.01 micro lots, every pip the market moves, he makes $1. Every pip is $1. So if the market moves 100 pips, he makes $10. If the market moves 200 pips, he makes $20 using the 1 micro lot size. How about if he uses 2 micro lot size? Every pip the market makes, every pip he makes, or every pip that goes against him, he either makes or lose 20 cents, like what you have here. Okay. If he's using 3 micro lot size, if the market goes for him or against him, he will make or lose 30 cents. How about if the person is a trader is using the mini lot size? If you're using one mini lot size, every pip that goes your direction will give you $1. Every pip that goes against you will give you minus $1. If the market goes for you by 100 pips, you make $100. If the market goes against you by 100 pips, you lose $100. Okay, that's the implication of using the mini lot size. How about the standard lot size? If you're using one standard lot size and the market goes your direction, you'll be making $10 for each pip. If it goes your direction by 100 pips, you would have made $1,000. If it goes against you by 100 pips, you would have lost $1,000. So you want to trade carefully. You want to know the right lot size to use, which is clearly defined by the size of your account. You have no business going to use the standard lot size on a $500 account. If you do that, you'll be risking too much of your capital. Okay, so how to know how much you're potentially going to be making on a trade is very simple. All you need to do is check the lot size you are using and the amount of pips you are going to be covering on that trade. I don't know if I can quickly give a very simple example on to that effect. Okay, so let me quickly do that. I'm going to give a quick example. How to actually calculate the amount you're likely to make on each trade. Okay, let's take a very good example. Let's assume we took a buying position from this level to this level. We took a buying position from here, or we are going to take a buying position. Okay, I'll just replay the market. We're going to take a buying position from here where the market is at the time to this point. And what we have here is 159 pips. That's what we would make if we buy from here. We want to know how much we are going to make from this trade, because you can tell beforehand if the market actually appreciates, if it actually goes up, you can tell how much you're likely to make on this very trade. Okay, so how do you know that? It's very simple and very straightforward. The first thing is you want to determine your lot size. What lot size do you intend using? Let's assume we intend using the one standard lot size. what will be our profit on this trade? Very simple. First of all, each pip, one pip will be one pip using the standard lot size. So we're using the standard lot size right now. One pip equals to $10. Okay, that's what one pip. And our target is how many pips? 159 pips. So what do? We multiply. We multiply 10 times 159, which will be equal to $1,590 profit if the market goes towards our direction. This is what we start to make. We start to make $1,590 on this trade. So at the moment the trade start reading, like what we have here already. So the trade start reading, and the trade start going towards that direction. We start making that amount of money. Okay, till it gets to our take profits and we got hit, we would have made $1,590 because we aimed for 159 pips and we use the standard lot size. I hope you get that. You can relate that using other lot sizes. If you use the mini lot, where you make, if you use one mini lot where you make $1 for a pip, you would have made $159 from that trade. If you use the micro lot, one micro lot, you would have made approximately 15 point something dollars from that trade. All right, so that's that for micro lots, for the lot sizes. If you're using your phone, this is how it appears on your phone. Okay, you have you can reduce your lot sizes from here. You can increase your lot sizes from here. If you don't do, you can just easily click on this. This is the lot size itself. This is one standard lot size, 1.20 standard lot size. Okay, all you need to do, you can just click on this and type in the lot size you want to use. Okay, these other spaces is where you have your stop loss, where you put your take profit, which I'll be discussing later. And this is where you have your pending orders, which I'll be discussing later in this video. Okay, so let's go on. The next thing we'll be talking about is leverage. What is leverage? Leverage is the money your broker borrows you. Leverage is expressed in ratio. While you're signing up for your trading account, you would see something like this. 1:50, 1:100, 1:200, 1:300, 1:400, 1:500. The one in this case is the amount of money you are ready to invest in the Forex market. Why this other amount here are the leverage your broker is giving you. Because ordinarily, with just your $100, of course, if you look at the previous slide, you'll notice if you have just $100, you can't even trade with the micro lot because there's no nano lot in Forex. Okay, you can't trade with the micro lot because, as you can see, the micro lot unit is 1,000. But meanwhile, you invested $100. So the least you can invest in Forex without leverage is $1,000. But through the help of the brokers, like I said before, you can't trade the market without the broker. The broker are the guys that gives you access to the market. So in this case, the one represents your invested amount. Whichever leverage you choose determine the elasticity of your account, how many trades you can take at a time. If you come into the market with $100 and you choose the leverage 1:100, you are open to over 10,000 units. And if you look at the previous slide, you can see 10,000 units, which means you can trade using the micro lot size. The mini lot size, I mean. You can trade the micro and the mini lot size, but you are nowhere near the standard lot size because you don't have enough money to trade. Okay. If you came into the market with $100 and you chose the leverage 1:400, what your broker do is they multiply your invested amount by 400. Your account size still remain $100, but you now have a margin that is over 40,000 units. And if you take a look at the previous slide, you would notice you can do more in the market. You can take more trades in the market. You can even come and do the standard lot, but trust me, it's at your own detriment. I won't advise you to go there. You can still stay within the range of the mini lot. Okay, so leverage is the money your broker borrows you. They give you more space to trade in the market. This doesn't mean your account size will increase. This doesn't mean your account size will increase by choosing the highest leverage. No, what will increase is the amount of trades you can take, the unit you can cover in the market, which is very important as well. Okay, so let's go to the next video. Look at the statement here. Leverage maximize your profit and your losses. So the higher your leverage, the higher risk you're taking in the market. Okay, so this is what leverage. This is leverage being explained. You can see right here we have $1,000. With $1,000, you can see you can even take position up to 100,000 units in the market, just because of the power of leverage. Okay, so one of the major things I'll be talking about again is margin call, margin level, margin call, and the rest. What is margin? Margin is actually a good faith deposit. It is the amount required to have in your account to keep a position open. Margin and leverage goes hand in hand. Now, remember when I was talking about leverage, I said it's the money your broker borrows you. Like I said, if you choose 1:100 or 1:200 or 1:300, your broker multiplies your invested amount by the kind of leverage you chose. Now, that multiplication is represented in your account as a margin. It is not as your balance. For the fact you came in with $100, you chose 1:500, doesn't mean you'll be giving $50,000. No, you'll not be giving it in amount. What you'll be giving in, it will be given to you in form of margin. What this margin will do for you is you can take more positions that is even almost equal to the amount of money you deposited in the market. Okay, so what is margin level? Margin level can only be seen after you have taken few trades. Your margin level is what is left for you after you have taken trades on your account. So it's the amount of money borrowed. It is the amount of borrowed fund the trader have access to. It's expressed in percentage. One of the ways to measure your risk is to observe your margin level. If your margin level falls below 1,000%, you have overborrowed. So you need to be taking a close watch at this. All right, I mean a close watch. When you're taking trades upon trades, you watch your margin level. It will be written boldly in your account, margin level. So you want to be watching out for it. When it goes below 1,000 for a big account, it shows you are over borrowing already. Okay, you might likely lose that account if care is not taken. Another thing you want to take note of is called margin call. Margin call is a signal from your broker alerting you that you no longer have access to leverage to trade again. Because when you keep taking too many trades with maybe the wrong lot sizes that are way too big, or you open too many positions while trading, you will get an alert from your broker. Sometimes they come through email directly to your phone. Sometimes you will notice a light blinking on your trading account telling you that you're over borrowing. Trust me, no broker wants you to lose your money, because when you lose your money, they go out of business as well. So they want you to keep trading. So they alert you on the fact that you are over leveraged and you may likely lose your account. So I think the last one, what is free margin? Free margin is the amount of space or the amount of units you still have to take trades. Okay, you still have this level of amount and stuff. In our practical section this Friday, I will be showing you this practically. Okay, so you don't want to miss it. It's 8 p.m. this Friday. Okay, so margin level is actually the space you have left to take trades. All right. Okay, with that being said, let's look at market orders. Market orders, because you want to be buying and selling in the market. So this is the client commitment to the broker company to buy or sell a security at the current price. This one involves some practical, which I'll be doing on Friday as well, but I'm going to take a little here. let's say this is CAD CHF like we have here. So I want to buy at the current, I want to buy or sell. Let's say I want to sell at the current market price, which is 0.72412. All I need to do is to click on new order. The moment I do this, I'm instructing my broker to buy on my behalf or to sell on my behalf, depending on the case. This is where I choose my lot sizes from. You can see my mini lot, micro lot, micro lot, micro lot, micro lot, micro lot, standard lot, standard lot. You can impute your, let's assume I want to use the mini lot 0.10. I've included my lot sizes. All right. I'm still going to come explain stop loss and take profit later. But for now, if I want to buy or sell, all I need to do at this point is I will click the buy or I'll click the sell. Such kind of order is called instant order. I am buying and selling at the current market price. So I just come and click sell or I click on buy. Automatically, my broker will take in my order and I am on a trade and the trade just keep running. But there is this type of order where you buy in the future. You are not buying at the current market price. You are buying later in the future. Such kind of order is called the pending order. It is the client commitment to the broker company to buy or sell a security at a predefined price in the future. There are actually four types of pending orders. We have the buy stop, we have the buy stop, we have the buy limit, we have the sell limit, and we have the sell stop. These are the four types of orders that we have in the market. Well, I will be doing practical of all these on Friday. I do this every Friday. So you want to join our Telegram group, you want to join our channel on Telegram. So from there, you get the link to join the class where I'll be doing the practical of all this stuff. Okay. All you need to do is you can check on our details. You'll find our Telegram channel link. Just click on it to be added. If not, you can just go to Telegram and type Shift FX Academy. Then you join our Telegram channel. From there, I'm going to help you run down through this practically. So we have the buy stop, we have the sell stop, we have the buy limit, and we have the sell limit. These are the four types of order we have. I'll be doing the practical on Fridays. Okay. How about stop? Another thing we need to talk about most importantly is stop loss and take profit. Stop loss and take profit. Stop loss is actually a limitation you place on your trade. It's a kind of risk management technique. Stop loss is actually the amount of pips you are risking on a particular trade, while your take profit is actually your target for that trade. So of course, as you know, when we trade, we risk small to win big. All this I'm going to be showing, I'm going to be teaching you how to do all this in our practical class on Fridays. So join our Telegram group and I will be giving you the practical of all this and how to incorporate it in your trading. Right? The last thing I'll be talking about are the trading sections. The Forex market is open 245, not 247. Some markets are open 247, like the indices market, volatility and stuff. But for Forex trading, the market is open 5 days in a week. The first section that opened the market is the Sydney section. The market opened 10 to 11 a.m. On the Sydney section, and while the Sydney session is running, the Tokyo session joins, okay, around 12 a.m. Why the Tokyo session? Because the Sydney session comes to an end by 7 a.m. While the Tokyo session is still running, the London session joins at 8 a.m. And while the London session is still running, the Tokyo session closes at 9 a.m. The London session running to 5 p.m. The New York session joins. So if you understand this session, you should know the Sydney session involves currency pairs like New Zealand dollar, Australian dollar, and stuff like that. The Tokyo session involves Chinese yuan and Japanese yen. You know, that's for the Tokyo section. The London section involves euro, US dollar. The New York section, of course, US dollar. The London section, GBP, and then euro and stuff like that. So all the practical for all this will be discussed in our Friday practical class. All right. So if you have watched this video to the end, you have successfully completed your beginner's course. Okay. So I want you to continue with us, watch more of our courses, and I bet you in just 60 days, you are going to be milking the market like a professional if you can take our courses back to back. Okay, so don't forget to like this video, subscribe, as that will enable us make more videos like this, and as well drop in the comment section the next video you would like to see, and I bet you within a short period of time that material will be made available to you. So subscribe so you can get all our materials once we drop them on the channel. All right, thank you for watching.